Well, hello, everyone, and welcome. Cynthia Tomaine here with Interactive Brokers, and you've joined us for today's webinar on sustainable investing, the next big growth opportunity. I'm very pleased to have with us this afternoon Platinum Echo Capital and Senior Portfolio Manager David Smith as a partner with Platinum Echo Capital, and Joe Pastore, who is the Chief Investment Officer as well. So with that, let me go ahead. I'm going to bring this over to our presentation slides and pass you the controls, Joe, so that we'll go ahead and get underway today. Dave and Joe, thank you for joining us here this afternoon. Take it away, gentlemen.
Great. Thank you, Cynthia. And we really do appreciate the opportunity to present this for Interactive Brokers. Welcome, everybody. This is Joe Pastore, and with me, as Cynthia said, is my partner, David Smith from Platinum Echo Capital. And we're really excited to be here today because we want to share something really special with you. And by the end of today, you're going to see that we're going to give each of you a gift. Our topic today, which could be considered a bit of a disruptor, is sustainable or ESG investing, the next big growth opportunity. And our gift to you is a glimpse of the future. Now, before I get to that, I want to just give you a little overview of how we're going to go through things today. So first, Okay, so what we're going to do is first, of course, have our introduction. Then I'm going to go over what is ESG exactly, and just on a basic level, so we're all on the same page. Then I'm going to describe who is Platinum Echo Capital, and then we're going to go over what is the opportunity. Now, to kick things off and put things in perspective, I want to share a quote with you from the movie Red, which perhaps some of you have seen. It stars Bruce Willis, Morgan Freeman, and Richard Dreyfuss. And in the movie, Richard Dreyfuss explains his company mission, saying, "We have a long-standing commitment to humanitarian causes, because exemplary corporate citizenship is our highest goal. As a company with global reach and global interests, we have global responsibilities." Now, sometimes I get asked if this commitment to ethical behavior affects the bottom line. And my answer is always the same. Yes, it makes it stronger. Now, the reason I share that quote is it sort of sums up corporate social responsibility, which is really at the heart of ESG investing. So what is ESG investing? Before I get to that, I want you to think about another movie that hopefully you've all seen, Back to the Future. You remember that one? Now, I want you to think back to something that happened in the second movie of the trilogy. And that's when Biff from the future comes back and gives Biff in the present a magazine. And that magazine contains the winners to every sporting event for the last 50 years. Now, Biff from the future's intention is to make Biff from the present rich by giving him the opportunity to bet on events in which the winner is already known. Now, imagine if you knew which companies were going to be the winners over the next 50 years, or maybe the next Apple. How would that change the way you invest? Wouldn't that be an incredible gift you wish someone gave to you? Well, today, I want to give you all a gift. Now, perhaps it's not as valuable as Biff's magazine of winners, but a valuable gift nonetheless. I want to provide you with a glimpse of the future by giving you a roadmap of how to find tomorrow's winners today. Now, another way to think of this, or those winners, are companies that have figured out a better way of doing things. So what is ESG investing? Well, there are many different investing philosophies within the responsible investing realm. Now, one of them is ESG, which stands for environmental, social, and governance. Now, research shows that investing in this method can reduce portfolio risk. It can also generate superior investment returns and can even help investors feel good about the stocks that they own. So it's no wonder that ESG investing is gaining traction. But first, let's demystify this ESG acronym and highlight what ESG investors look for in the companies that they want to own. Now, once again, the E is for environmental. Now, I want to be clear about this. Environmental does not mean companies and environmental industries. It simply means how companies impact the environment. Now, the environmental component, it looks at companies' impact on the earth, both positive and negative. And some of the environmental topics that we'd look to analyze a company would be things like climate change policies, plans, disclosures, maybe greenhouse gas emissions and goals, carbon footprint and carbon intensity, i.e. pollution and emissions, water-related issues like usage, conservation, overfishing, waste disposal, use of renewable energy, including wind and solar, recycling, safe disposal practices, green products, technologies, infrastructure, relationships and past history with the EPA and other regulatory bodies. So that sort of sums up what the E is all about. Next is the S for social. And when we're talking about the social component, what we're really talking about is anything people related. And those are elements like corporate culture and issues that impact employees, customers, and suppliers, both within the company and how it interacts with society in general. Some of the social topics that we might look at would be things like employee treatment, pay, benefits, perks, employee engagement and staff turnover, employee training and development, employee safety policies, including sexual harassment prevention, maybe diversity and inclusion in hiring, customer service responsiveness, and history of consumer protection issues, including lawsuits, recalls, regulatory penalties. You may have heard that Amazon can be a pretty cheap company, and sometimes they have employees use old doors for desks. Now, policies like that would negatively impact their S or social score. And finally, the G is for corporate governance. And corporate governance relates to the board of directors and company oversight. Or more simply, ESG investors analyze how corporate management and boards relate to different stakeholders and how the business is run, whether its corporate incentives align with the business's success. Now, some of the topics here we might look at would be things like executive compensation, bonuses, perks, compensation tied to long-term business values, not the short-term stuff like EPS growth. Now, diversity among the board, whether the chairman and CEO roles are separate, maybe dual or multiple class of stock structures, transparency in communicating with shareholders, maybe the history of lawsuits brought about by shareholders, and of course, relationship and history with the SEC and any other regulatory body. Now, who is Platinum Eco Capital? Okay, Platinum Eco Capital is an investment management firm that specializes in sustainable investing. Our mandate is to generate superior risk-adjusted returns through active management from opportunities arising from transition to a more sustainable economy. Our equity strategy takes a concentrated approach based on fundamental analysis investing in publicly traded companies that are leaders in the transition to a more sustainable economy. ESG and impact is seen as driving values and above market returns. Platinum Eco Capital, we're 100% employee owned, and our management team has an average of 25 years experience. Now, let me tell you a little bit about myself. I've been doing this for over 35 years at a variety of places. Before starting Platinum Eco Capital last year in 2019, I was a senior portfolio manager for both Merrill Lynch and for Morgan Stanley. Before that, I worked for Wilshire Associates, and there I managed a $2 billion hedge fund for some of the largest pension funds in the country, like CalPERS, Koch Industries, IBM, Raytheon, and even Royal Dutch Shell. Before that, as a portfolio manager, I ran the trading desk for American Express Bank International's Beverly Hills headquarters. There I managed about $200 million in assets. I got my MBA from Pace University, my undergraduate degree from NYU. Some of my designations include CRPC, which is Chartered Retirement Planning Counselor. I have a degree in financial planning, and I'm a certified divorce financial analyst. And I've also written several books on investing, including The Investment Handbook, How to Profit from Market Volatility, eye of the storm, and even the Trump trade. So I've been doing this a really long time. I've been involved in ESG for a while, and it's just the absolute place to be right now. And I want to get that message across to you by the end of this presentation that this is the time for this. But anyway, now I would like my partner David to introduce himself.
Good morning. Great to be here. First of all, I'd like to thank Interactive Brokers for having us, and thank you for joining us. In terms of my background, I think the relevant piece as it relates to our discussion today really is I have about 25 years of experience looking at the progression of what I would call ESG as to where it's gotten today. So if I look at my early days at Citigroup, I was the founder of the group targeting alternative energy. From there, I actually went on to see areas such as clean tech as they emerged, which would really be encapsulated probably by small mid-cap industrials. And that transitioned into sustainability and SRI in the late 2010s, or 2000s, sorry. And then in the 2010s, we've shifted more to a focus of what I would call ESG and impact investing. So most recently, prior to Platinum, I was the founding partner and CIO of Green Tech Capital's asset management business. We managed at peak about $700 million in assets in long only and long short strategies. Prior to that, I worked for a gentleman named Mario Gabelli on the East Coast. I was portfolio manager of the Gabelli Green Fund. I also established the Gabelli RBI, so Roads, Bridges, and Infrastructure Long Only Fund. Previous to that, I was at a long short firm called Longbow Capital, where I was responsible for infrastructure, renewable energy, and industrial sectors. And previous to that, I was on the sell side for 10 years at Smith Barney Citigroup, as I mentioned previously. So with that, I'll just give it back to Joe, and then we'll jump into some details.
Okay, thank you, David. So the world is changing. What is this ESG investment opportunity? Basically, because of what's going on now, investors expect corporate responsibility. They want the companies they invest in not only to earn a return for them, but have a negative or a neutral impact on the world. And that really, one of the biggest things we're going to be talking about is decarbonizing or reducing our carbon footprint. We want to direct capital to companies that either provide specific solutions to decarbonizing or at least be transition leaders in decarbonizing and adopting social and governance measures internally, as they stand to benefit most from the resultant significant growth opportunities and the competitive advantage that can result from implementing sustainable practices. We want to focus on companies that focus on climate change. Who are the leaders that are making an impact in creating solutions? And social impact. Which companies are bringing people together for societal change? Disruption. Finding a better way to do things. I mean, you hear all the time about disruptors like, Tesla and Uber and Airbnb. These are the kind of companies that make sense. We're also talking about transitioning, new and old companies, the growing universe, the move to mainstream. Thematic growth. These are when secular opportunities that help solve a problem and give you a competitive advantage. We also want to tap into investors' desire to have an impact on all their investments today. Now, before us right now, it's a generational opportunity. Okay, disruption is going on all over the place. The metrics of who invests in the market is changing. The CDP estimates that 2.1 trillion opportunity for climate-friendly products and services that have an environmental impact in just the next 5 years alone. So we know the world is changing, we know this is coming, and we want to be part of it. The rest of the world has already seen the ESG investment opportunity, where the US seems to be lagging behind, but all that may be about to change. Okay, so now I'm going to turn it back to David to talk about evolving approaches.
Thanks, Joe. So first off, looking at the slide here, ESG investing has evolved. Investment managers have adopted several approaches to investing in and around sustainability since the early 1970s to really focus on corporate citizenship. More recently, investing has evolved to target sustainable business practices, products, and services. And really what we're doing is seeking the leaders in both sustainability solutions and best-in-class operations. So when this got off the ground really in the 1970s, negative screening was really the buzzword. It was really the focus of the procedures and the processes as far as ESG and sustainability investing goes. Now what this did, it really excluded companies and sectors. So it was negative. It excluded certain areas, and these included things like gambling, defense, alcohol, and tobacco from investment based on sustainability concerns and controversies. What I would call it really is values-based investing. Shift forward to the past decade, and we've seen more of what I would call positive selection. Really, capital allocation is really given to companies seen as best in their sector on environmental, social, and governance factors and scoring. So really what we're calling it is values. The values piece is still there, but you'll also get a return. And there's two approaches that have really evolved. The most popular being integration, and this is what you probably hear on more on a daily basis, provided as far as the broader universe of markets and stocks goes. But really, it's combining analysis of ESG issues with fundamental analysis, and really a focus on transition risks and opportunities. It's really applicable across the entire universe. So, companies in the tech area, utilities, energy, healthcare, et cetera, you can apply this across the whole S&P 500. The second area is thematic, and this is where I see more growth opportunities. As investors, we tend to look for growth. So really, this allocates capital to what I would call solutions to sustainability challenge. It really picks the best-in-class companies based on fundamentals, but also seeks to define the impact those companies are having. So in the green boxes there, you really look at it and see a summarize, fundamental analysis, ESG risk management is critical in this process. Cost and risk reduction. So when I think of water, I think of energy, I think of reducing scrap in the process. I also think of using things like renewable energy, which might cost less than the grid, or focusing on supply chains. But the net is that really we're looking for value creation and solutions. The net effect here is what we call the triple bottom line, a focus on people, planet, and profits, really managing risk while generating sustainable long-term returns. Thematic is the area that offers the largest growth opportunity. We want to be long growth in areas that solve problems and really matter for people on a daily basis. Coming back to those points that Joe mentioned, in emissions, societal issues. Really, we're buying change that has impact. So if I go to the next slide, really, when I talk about impact, it's got to be direct and it's got to be measurable. It's really got to have a positive. The net is that we're looking for positive environmental and social outcomes. And the guidance here has really been driven by what we call the United Nations Sustainable Development Goals, or SDGs, that are leading the way. We want to invest in companies that help further the advancement of the key UN Sustainable Development Goals. And there's 17 of these. The most applicable to the thematic strategy are listed there, and then the 9, really, but we're emphasizing the social and environmental impact that an investment can make. Funds that target ESG and impact tend to be performance-focused, really purpose-driven, and have an eye on the impact delivered to the stakeholders, which is very important as far as shareholders go that are investing around ESG. Sustainable investment practices can lead to superior long-term alpha generation. We found this. Shareholders look to own companies that have a measurable positive impact towards the transition to a lower carbon economy and social benefit. So the focus is not, though, just investing in a company because it scores well on ESG measures. We don't think that's really where the greatest opportunity here. It's really finding the best companies that are leading the respective industries with solutions and driving above peer returns through things like risk abatement, market share gains, and cost reductions. So ultimately, you see a higher return on invested capital here, and ultimately a lower cost of capital, which we believe will drive the stock price. So switching to the next slide, our approach when we look here at the thematic and the solutions-driven focus, really we're looking at impact and disruption. We're seeing a generational shift in investor appetite that's really going towards ESG, sustainability, and impact. The process here is really as a long-term private investor approach, a low turnover based on secular growth. As Joe mentioned, we're seeing $2 trillion, upwards of $2 trillion plus in spending annually. We see a very strong next 5 to 10 years as far as spending goes for these companies. Sustainability represents a once-in-a-lifetime change with a massive investment opportunity. We really focus on the companies that are driving measurement. Data really is the key to this. Companies that are driving data through their processes and can show that there is an impact. The investable universe is growing. What I like to say is that companies have to evolve or become obsolete. And you've seen this, on a daily basis. Auto companies versus the incumbents or the new startups. Companies like Tesla or Rivian that are coming along versus the incumbents, the Fords and the GMs. They have to evolve or they ultimately become obsolete. We believe that capitalism is best suited to solve the environmental problems and risks of emissions through disruption facilitated by economics that result in a better way of doing things. Regulations are a catalyst, and I think they're important. It's early days, and like I said, I've been looking at this for 25 years, but the regulation piece is an important catalyst, but economics are ultimately what drive the commercial viability and market success of long-term sustainable solutions. So we'd like to see incentives and everything fall by the wayside at some point, but really what it's doing right now is opening new markets. And we've seen this before. Let's look at LED lighting. When LEDs came out, they were $35 a bulb in 2006. Today, you and I can run down to Home Depot and buy an LED bulb for about $1 a bulb. What it's done is it's displaced the incumbent, which is incandescent bulbs. Solar and wind. When I first started looking at solar in 1997, 98, solar was $12 per watt for a solar panel. Today, it's 20 cents per watt. So it's clear where the commercial markets are headed, and market adoption is with that form of generation. Now what we're seeing is the electrification of cars and trucks, and this all bodes very well for the consumer as the cost of these comes down and the market entry opens. So what I would say is that more investors are demanding an ESG focus when they look at investing. It started in Europe. It's certainly heavy on the U.S. West Coast around California. We're seeing more of a focus towards the East Coast. More people are asking for ESG. Technology is an enabler. I think that's a critical piece of this. And what it does is it yields a better way of doing things. But the underpinning here is really opening up significant mass markets. And really those markets are opened up through a better cost structure. So I just want to quickly jump on the next slide. I think this is very interesting. And this is the past decade, but basically the S&P 500 member weightings by sector. And the red line you see going down is energy. So, whereas energy between the 70s and the 2000s was really the focus of a lot of markets and capital raising opportunities, in the past decade, we've really seen energy as an investable sector drop by the wayside. What we've seen on the other side, picking up the slack, is technology. And this is critical looking forward. And we think that technology really drives disruption and it enables sustainability and problem-solving opportunities. And this is what we're starting to see much more in the companies that we're following. Just an example. So on the next page, on page 12, you can see here over the past decade what's happened to the cost of solar. So solar's gone from about $250 a megawatt hour about a decade ago down to today roughly $20 per megawatt hour. We're seeing significant cost reductions on the solar side. I mentioned from $12 to 20 cents a watt. This is where the volume is. This is where we're seeing significant growth, Similar on wind, which was about $130 a megawatt hour, also is down to about $20 a megawatt hour. We're seeing additional discussion of further cost declines, but the net is that we've seen a 90% drop in the cost of solar, an 80% drop in the cost of wind. In the meantime, coal has stayed very consistent, around $100 per megawatt hour. Lazard's levelized cost of energy analysis came out just this past week and really reinforced the cost opportunities that are there for solar and wind. And, I've talked to utilities for roughly 2 decades now, and the smartest utilities are all making their capacity additions really around renewables these days. And when you think about it, the upfront cost, the initial cost is really the focus here. And beyond that, there's no marginal cost. There's no energy cost. There's no buying coal. There's no buying natural gas. There's no delivering it. There's nothing focused on really getting rid of the waste after it's been burnt, for instance. And so this is where renewables have done very well. And if that first cost is lower, and the levelized cost of energy, which is really the cost of producing energy, is significantly lower than those incumbents, our view is that you'll see coal fall by the wayside. And we're already seeing that. We're also seeing nuclear do the same. So flipping to the next slide, kind of hitting home here, what I like to say is that green has to be green. Emerging innovative technologies that facilitate a low carbon transition is really what we're focused on here. Renewable energy, solar and wind, have reached scale. More costs have come out. Technology has played a bigger role in the game, and it's going to continue going forward. And it's continuously evolving. Today, we've seen thin film solar, we've seen silicon solar, and now we're seeing perovskite solar, which has higher energy conversion, really driving down cost further. So cost has opened the door to what I would call mass market commercialization. Volume-led experience curves are opening new markets. So an experience curve is when you get a doubling in production. So when I look at what does it do to the cost? So when I look at solar, for every doubling in production over the past 20 years, we've seen about a 25% reduction in cost. When I look at batteries, it's more along the line of about 21%. But the net is that we're seeing, as more volume comes, cost is coming down. And as I mentioned, utilities such as NextEra, Florida Power and Light, Mid-American, they're shunning coal and nuclear for the cost certainty of renewables. So there's no fluctuation, as I said, in the price of electricity, and you can do long-term contracts with much more certainty. Economics has and will continue to lead the markets ahead of regulation. I want to emphasize that. So the ESG solution and transition leaders that we're following offer both growth and they offer value. So what we're finding, really, the dominant universe really is small and mid-cap growth names with attractive valuations. I'd like to say growth at a reasonable price, but we're looking at, in a lot of cases, companies that are trading at 8 to 15 times EBITDA forecasts with 20 to 40% growth. So this seems like a fantastic opportunity given the growth curve we're going to see over the next decade. We're seeing a wide array of enablers in the value chain as well. In most cases, these names and sectors are underfollowed by Wall Street. So this is a great time to be participating. We're seeing an upcoming expansion in underappreciated areas, including vehicle electrification. You've probably heard a lot about these days when you look at SPACs and other instruments that are out there. Vehicle autonomy, vehicle telematics, battery storage systems, renewable energy, and hydrogen. Flipping to the next slide, I just want to quickly touch on the COVID-19 crisis. It's a once-in-a-lifetime opportunity to affect change as a result of the coronavirus pandemic. The focus really here is on drivers of performance and investor beliefs, and this is weaving itself into the fabric of ESG. So ESG and impact funds have really outperformed in 2020 with lower volatility, and what we've seen also is a lot better downside protection. This might be due to a lack of fossil fuel in the portfolios and mining exposure, but it's more likely due to being invested in growth and companies that can better account for risks along the way. ESG score companies are definitely seen as beneficiaries to kickstart economic growth. You've probably heard a lot about infrastructure programs being discussed as stimulus programs. So what we're seeing is pull forward. It's really evolutionary technology, and it's a lot of disruption themes. We're hearing about reduced emissions and waste. You've probably seen cleaner air, less traffic congestion over the past few months. Accelerated digitization, strengthening of governance profiles at companies, social awareness toward employees, diversity, inclusion, and community. So shareholders are becoming increasingly engaged, and regulators are stepping up disclosure requirements that could have an impact on a company's outlook and risks. Smaller firms, we think, are the best aligned to vote those sustainable shareholder interests. So flipping on to the next slide, just touching on some of the bigger investment themes that we are seeing. The energy supply shift, really focus on renewables. Climate change, as Joe mentioned, companies that are self-contracting renewable energy. It's not just governments, but we're seeing companies do that, and it's really focused on and lowering their CO2 footprint. Clean water supply is a very relevant issue. When we hear some of the municipalities and countries, and water scarcity and water quality is a big issue. Transportation, electrification of vehicles, ride sharing, autonomous driving. Certainly, these are also big issues that we're keeping an eye on. Biofuels, energy storage, electrification, and more energy storage, both in the grid and for vehicles. Arable land, really talking about agricultural yields and the quality of food and processing. Building and lighting efficiency, really focusing on less energy waste in buildings. Grid upgrades are important, and then sustainability-focused consumers. You've probably seen a lot of consumer companies. I can think of shoes like Allbirds to foods on the organic side. There's more consumer focus on sustainable products. Flipping into the next slide, taking themes a step further, they're all about solving problems. And I think that's what really is the driver here. Is we're solving problems in massive market opportunities, creating a significant opportunity to invest. These shifts represent some of the biggest challenges of our time, and they're very, very large market opportunities. So, when I look at food production, for instance, food production is going to have to increase 50% globally by 2050. So we're going to have to get more out of an acre of land. When I look at air and environment, we're really talking about air pollution that exceeds safe limits. When I talk about renewable energy, we're talking about greenhouse gas emissions and the ability to offset. And obviously, the Paris Accord plays heavily into that. When I look at power and energy infrastructure, globally, there's more than 1 billion people who don't have access to energy. So think of things like solar panels and microgrids that are providing access in areas like Africa and India. Advanced mobility, safety, really on the road, and then water. When I look at water scarcity affects over 40% of the global population. Roughly 3% of the world's water is potable water, drinkable water. 97% is not drinkable. So there's clearly a focus on that globally in terms of quality of life. So on the next slide, I just want to touch on process. What we do is we're investing in solutions. As I said, we're really looking for problems and solutions. The investment universe is impact-driven and comprised of companies either providing solutions or leaders in the transition and set to benefit from increasing global focus on sustainability and a need to do more with less. So we look at about 500 companies. They're companies that are providing solutions and making an impact and will drive superior long-term returns amid secular growth. So this isn't cyclical. This is secular growth and disruption. I list off about 7 of the bigger problems that we see in the universe that are affecting these companies. But this drills down again to those subsectors and where we tend to focus our energy and the opportunities as far as solving problems go. The next slide on process, the approach is in really finding companies that provide solutions as well as transition leaders that are supporting a more sustainable, lower carbon economy. Many of these companies are disruptors in their fields today and often seen as leaders of what I would like to call creative destruction, creating an opportunity, or as Joe mentioned earlier, really a better way of doing things. At the end of it, at the beginning of it, I should say, we're focused on ESG integration. So integrating material ESG factors into the research process as we start to look at a company and help find the factors that drive performance of these companies and help mitigate risk and create a positive change for stakeholders. So flipping to page 19 on process, the key is finding companies that have a positive environmental and social impact. These companies will grow their market share. And I think that's critical. When you look at companies that are providing renewable energy to data centers, they're growing their market share because their customers want to be involved with that. They have stronger returns over time. They're exhibiting better risk awareness, and they see a lower cost of capital than those that do not embrace sustainability as a core tenet. So, in terms of strategy, we really look for value with a catalyst. You can find all kinds of value in the market, but I think most importantly, you've got to find a catalyst that's going to unlock that value. So we really look for opportunities to find those disruptors and the enablers and the winners and losers and get to know that technology early on. As I said, I've been looking at this for 25 years, and I've seen all kinds of opportunities on the technology side and how that evolves. And so it's really a quick changing process. As far as what we do at Platinum Eco, we're really limited in the field of U.S. investment professionals. Not many people have looked at this for a long period of time. I've got an 8-year track record as a portfolio manager looking at this area. So there's only a handful of people, I think, who really truly get this process. What we're seeing, though, are a lot of asset gathering by larger firms, and greenwashing is abundant. This is really larger firms that are not reflecting on their proxies, their process, and their engagement, what they should be doing as far as ESG and sustainability goes, and reflecting the interests of people who invest in those funds. The opportunity here is really to be positioned to outperform. We're really looking for growth and those companies that are leading their sectors. And the objective is superior long-term alpha generation, really companies that are having a material impact, and this will drive their share price. Just quickly touching on value with a catalyst. I mentioned this a second ago, but as far as that catalyst, we really look for 4 drivers here. Companies that are disruptors. And the classic example, and you're hearing about this today a lot, is Tesla. You could see Tesla as it's really driving the opportunity for electric vehicles, and it's become real. And the response is also tangible when you look at the incumbents in the area. Other areas of disruption might be renewable energy, for instance. Evolving business models. One company I talk about a lot is A.O. Smith. They've made water heaters and water treatment products for years, but they now are starting to focus on really the most efficient water heaters and the best filtration and processes for cleaning water. So there's a catalyst that can be unlocked there. Regulatory driven. When I look at the wind industry or the solar industry, there's certain states have mandates as far as renewable energy goes, and other states might really focus on coal and issues around mercury, and we see this as a benefit for Vestas and companies like First Solar that are involved in wind and solar. Similarly, CAFE standards for cars, but ultimately what this drives is a lower cost and a benefit to the consumer. Cyclical recoveries is really the last catalyst that I look for. When I think about energy efficiency for buildings, for instance, there's a lot of companies that do things like lighting, for instance, or building control systems. Companies like Acuity that do lighting control systems for buildings, focus on building efficiency, reduction in emissions in buildings, or companies like Xylem that are really focused on municipal and industrial water applications. So the way we, when we have those catalysts, we focus on companies, value chain analysis really for idea generation. We do due diligence on the companies and ultimately portfolio decisions. So this is really marrying the ESG process with the fundamental analysis. So if I flip to the next slide, you can get a sense of what the value chain analysis is. But the key here is that these value chain maps sort the enablers. So while I might not invest in Tesla today, maybe I feel that's not the best place to be. There's a lot of controversies around Tesla. There might be companies that make electric motors. There might be companies that make sensors or controls or really the brain of an autonomous drive system that are worth investing in. So we do focus really heavily on the companies that benefit from these larger trends. I want to quickly jump to slide 28, and you can see a little bit better about the process as far as the subsector focus goes. So when I look at advanced mobility, the macro theme on actually I think it's the prior one, Joe. The macro themes that are really being addressed from an ESG perspective are improving road safety. Roughly 35,000 people per year die in the U.S. from traffic accidents. Promote sustainable transportation systems, and then promote electrification of the vehicle. And you can see below the two SDGs that we pull out on this. But then secondly, there's a couple companies here on the right, TE Connectivity and Sensata, that are really focused on sensors and systems for autonomous driving and improving road safety. But taking it to the next slide, this is a blow up of the value chain slide that you just saw, and you can see how we look at this, really understanding the auto industry or the light vehicle industry from a top-down perspective and getting a sense of where the industry is, and then also taking a closer look at who the companies are in that value chain, looking for the constraints and the excesses in that value chain. The excesses are commodities. These are the companies that are really more cyclical. We're looking for the constraints, areas like telematics or controls or vehicle electrification, areas where there's demand and constraints, and we have a higher rent really being paid, a higher return coming over time. So that's really important for us, but we map out each one of the 8 subsectors that I mentioned as far as the enablers go in the value chain. So let me just flip back to page 22. So now really ESG is integration into the investment process is something I quickly want to talk about. But when I think of environmental, social, and governance analysis, this is integral to identifying successful investment ideas that also reduce risk as an investor and to the companies and the constituents around the companies. Corporate transparency, as well as consistent data from the providers, will enable widespread adoption of ESG practices over time. So if I look at those 3, environmental, social, and governance, you see some of the bigger issues there: emissions, resource intensity, energy management, waste reduction, water use, disclosures on the environmental side. On the social side, customers, employees, product quality, diversity and inclusion, worker safety and communities. And then on the governance, really board structure, gender, race, and diversity, supply chain, transparency to stakeholders, and then shareholder rights. But what we think this all translates into, our strong belief is that you see companies that exhibit superior growth, higher profitability, and in time, achieve a greater valuation. But we want to own these companies before the street knows about it, before investors are there. We want to own them, as I said, growth at a reasonable price. Just lastly here on the ESG integration workflow, proper environmental stewardship is a necessity, but really not a sufficient condition for inclusion in the portfolio. Really, again, fundamental investment analysis still rules in making a decision whether something is a worthy investment. So we do proprietary analysis, and I think you have to really look at it from the point of view of what's the opportunity, not just the data from a data provider, but also the fundamental analysis. So we look for a minimum of 20 that could translate into 50% of revenues coming from sustainable products and services or transition opportunities. And then we also marry that up with true cost data from MSCI and really look at it and really try to understand the carbon intensity. So it's marrying up the data with the fundamental at the end. And this is what really dictates whether or not something is worthy of inclusion in the portfolio. So lastly, on process, on the next slide. Now this is very important, but this is what, 25 years of knowing these companies and knowing management teams and running portfolios really benefits, I believe. But, we're really looking for engagement for impact. ESG related disclosure continues to improve for a lot of the publicly listed companies. Last I've seen is 90% of the S&P 500 companies now do what's called the sustainability report. There's a lack of consistency on reported data-driven factors amongst the providers, though. It's imperative to engage directly and constructively with management teams. This is a relationship thing, and it's important to have these discussions. Company management teams increasingly have been asking us how they can and should be reporting on sustainability initiatives to the investor community. This question is coming up a lot more for management teams, so it's indicative of where we think that the market is headed. Proxies can be voted in accordance with proactive changes related to the SDGs. We're seeing this quite frequently now. Engagement allows feedback to management and advocate for improvements in policies and practices. Morningstar, I was just on a presentation yesterday, but Morningstar has found that companies that address shareholder ESG concerns do perform better over time, that the stocks do perform better over time. So engagement strategies need to be prioritized by where the investors can have influence on companies to change for the better and help create longer term sustainable value. And some of the more pertinent things that we're starting to hear about today, plastics use, carbon emissions, energy efficiency, and most importantly as well, the labor practices. So with that, let me hand it back to Joe and then I'll wrap up.
Okay, thank you, David. Now, basically, we've talked a lot about some of the details of ESG investing, but I want to make sure we understand how important this is to redefining the landscape for investing. Okay, ESG investing is going mainstream, whether we like it or not. Investors are demanding companies become better corporate citizens. ESG impact and profit-laden movements as companies realize they can do well by investors and still make money and still do the right thing for the planet, having a good rate of return and doing the right thing for their employees. Now, record inflows are being reported to ESG funds, and we can see this among the uncertainty. Morningstar notes that inflows to sustainability funds have doubled in the first half of 2020 to $20.9 billion versus $21.4 billion for all of 2019. And 2019 was a quadrupling year over year of 2018. Global ESG saw a $71 billion net inflow in 2020 in the second quarter, which is up 72% year over year. ESG funds have outperformed relative to the broader market funds, and they've done it with less downside. Investors are seeing growth potential of products and services that have impact. The investor base finds significant appeal to the next generation. There's a growing recognition of secular growth opportunity, a very, very strong attraction to disruption and secular change, and young investors are demanding change. Morgan Stanley sees the rise of millennial and women investors. Deloitte study shows that 24 trillion wealth transfer to millennials over the next decade who once again prefer ESG type strategies. It is a firm belief, and it's increasingly supported by data, that sustainable investing can generate investment returns better than strategies that do not incorporate ESG principles. Let me share something with you. A little over a year ago, in September of 2019, California Governor Gavin Newsom announced an executive action to leverage state pension investments to strengthen California's climate resiliency. He directed the Department of Finance to create a climate investment framework to leverage the state's $700 billion investment portfolio and major pension plans like CalPERS, CalSTRS, and the UC retirement system. And he did this to advance California's climate leadership. The executive order directs multiple state agencies and departments to review investments and use the state's purchasing power to advance groundbreaking climate goals. He went on to say that California, which is the 5th largest economy in the world, is stepping up and leading the way. Our state is proof that you can reach some of the strongest climate goals in the world while also achieving record economic growth. And how we meet this moment will define our state and country for decades to come, just as the emergence of the internet defined our economy over the past few decades. We have to get ahead of this and align our state investments and be ready to meet this movement head on. Now, California has pretty ambitious climate goals for a transition to a healthier, more sustainable, and more inclusive economy. We want to reduce greenhouse gas emissions by 40% below 1990 levels by 2030, provide 100% of the state's electricity from clean energy sources by 2045, and reduce methane emissions and hydrofluorocarbon gases by 40%, and add 5 million zero-emission vehicles to California roads by 2030. California continues to invest in new technology programs and best practices to lower carbon emissions. And as the state transitions to a carbon-neutral economy, the state's investments must align with the reality of this major market shift. The California Executive Order directs the Department of Finance to create a climate investment framework to measure and manage climate risk across the state's investment portfolio, with the goal of driving investment toward carbon-neutral and climate-resilient technologies. The framework will provide a timeline and criteria to shift investments to companies and industry sectors that have greater growth potential based on their focus of adapting to and mitigating the impacts of climate change, including investments in carbon neutral and carbon negative and clean energy technologies. Wow. So basically, ESG investing is being mandated by the state of California, the 5th largest economy in the world. How can it possibly fail? I mean, talk about a self-fulfilling prophecy. Here's another little quote for you. The best way to predict the future is to invent it. And that's what's going on right now. The ESG or sustainable investing movement, it's here now. It's going on, and you can start to take advantage of this next big growth opportunity. And here we are, a couple of weeks from the election. A Biden win, or certainly a blue wave, only accelerates this process. Should Biden emerge victorious, renewable energy, electric vehicles, telecommunications, they're going to be big winners here. And even if there's not a blue wave or non-Biden win, this trend, it can't be stopped. This is what's happening. So we really encourage people to notice what's going on around them and to say that this is the time for this. The pandemic it's forced us to focus or refocus our priorities on certain things. So this has become more center stage. I want to turn this back to David now, and he's going to wrap it up, and then we'll take some questions.
Yeah, thanks, Joe. Page 26, just to summarize, I call it a cheat sheet, but net, what I'm telling you to do is stay current, really spot the shifts early, and that's the best time to be invested here. So stress the opportunity. This is really the time to be doing this, as Joe just mentioned. You know, California, as you probably heard, not only has instituted all those programs that Joe mentioned, but also you probably saw they're reducing, or sorry, they're excluding the sale of fossil fuel cars by 2035. California tends to be the leader in the United States for climate, and certainly we expect that a wave could move over the rest of the country. But we want to own change. We really want to own change, and we want to own companies that are solving problems. We want to be long growth areas that matter and solve problems today. Disruption drives investment opportunities. Trends that are worth noting, I talked about the shift away from energy to technology. And really, the declining cost of disruptors. I've seen it in solar over the past 20 years. I've seen it in building efficiency, energy, light bulbs, and we're seeing it now happen in transport and mobility. Really, where there is momentum today is electric vehicles, solar and wind, battery storage, and now we're starting to see even more talk around hydrogen. Near-term catalysts, COVID, we mentioned, it's really pulled forward. The green recovery stimulus is certainly something that could happen under a Democratic administration. And then infrastructure is certainly something that could get us back on economic growth track. Acceleration of societal trends, you've all seen this, work from home, digitization, home video, food, social, medicine. We're seeing all kinds of change opportunities here. Election, the U.S. participation in the Paris Accord is on the table. Biden's $2 trillion proposed spending for green over the next 4 years. We're even seeing things like sustainability-linked loans. Companies are actually seeing the cost of debt affected by ESG scoring, and this can vary on a 6 or 12 months basis. But companies are benefiting from this, and they're seeing the value of moving in this direction as far as their capital structure goes. Longer-term trends, renewables. We've talked a lot about corporate shift. A lot of companies are starting to adopt renewables. Corporations that have the most influence over legislators now are technology companies. It used to be more focused on the energy arena. Divestment from fossil fuels, first it was coal, and now we're starting to see the same happen around oil. The cost reduction of renewables is critical over the long term, lessening impact of regulation. We're keeping track of that. Consumers are getting more options, such as generate your own electricity, organic products. Electrification of society is happening today. People are plugging in cars as well as their cell phones. We're seeing a mobility shift to electric vehicles. The evolution of utility power generation is happening rapidly away from fossil fuels towards renewables. We're seeing more focus on battery technology, both stationary and mobile. And like I said, hydrogen is starting to play in the game. So with that, let me hand it back, and certainly we're open to questions. Anything you'd like to discuss, we're here.
All right. I have one question, or I have a couple of questions here. And the first question is sustainable investing viable without subsidies? Now, it's a very interesting question, but the reality is it's a myth that sustainable investing is only for investors who prioritize social and environmental impact over financial performance. Today, a large and growing body of evidence shows there's a relationship between positive ESG practices and financial outperformance. The evidence is making sustainable investing compelling to an expanding universe of investors who understand they can make an impact and improve the potential risk-adjusted returns. And that's really what this is about. We want to do the right thing, but yes, of course, we want to be paid for doing it. That's why, according to a recent survey, 71% of institutional investors hope to manage their portfolios in accordance with ESG principles by 2030. So once again, more evidence that this trend is happening. There's another question.
What I would add to that, not to cut you off, Joe, but I would also add, what we're seeing is that significant reduction in cost is driving wider market acceptance. So commercialization really, what I like to say is green has to be green. There has to be a positive net economic return to businesses, or there has to be a payback model that makes sense for a consumer. You're not going to put solar on top of your roof if it's going to take you 25 years to see a payback. The analogy I like to pull out here is a fridge, for instance. A lot of people, when they buy a new fridge, they can't bring themselves to separate themselves from that old fridge. But the old fridge inevitably ends up out in the garage, and it becomes, say, a drink fridge, or a second fridge. And the fridges and appliances, common household appliances that were built in the 1970s and 1980s, use 5 to 6 times more electricity than Energy Star appliances today. So, within 5 to 7 years, at an additional $200 per year cost of operating that additional fridge, where people sit there and say, what's driving my energy bill so high? It's this fridge. And so The fact is that these, sustainability driven, better, more efficient appliances are seeing market acceptance, and people realize the benefit. And it doesn't have to be the fridge. It could be, an LED bulb uses 80% less electricity, and it costs roughly, about the same price at $1 a bulb, and it lasts for 15 years. So I think that's really, the economics are subsidized in a lot of cases from day one when you look at things like solar or electric cars. But as I said, I don't see long-term opportunities unless they're consumer desirable products that have that make economic sense. And that's what we're seeing when I talk about things like experience curves.
All right, thank you. There's another question here asked by Lorraine, and it's talking about an article in Forbes that I know obviously most of you probably haven't seen, but it's basically saying, ESG investing is not what it's cracked up to be. And the crux of the article is, well, it focuses too much on the E and less on the S and the G. And that's not really true. And if you really want to get into ESG funds, there's something I need to say here is that, David is managing ESG funds for over 8 years. That track record, there are less than 5 other managers in the entire US that have such a long track record. So if you're looking at ESG funds, you got to look at what's in it, because a lot of ESG managers have jumped in kind of as Me Too's, and what they did is they kind of just stocked up on the FANG names because some of them loosely fit into this category, and it was an easy call. But if you look at what we have in there, and I'll let David talk about some of our portfolio holdings in a minute, or in any portfolio, look at what's in there. If they are just loading up on the FANG stuff, yeah, it's probably not a real ESG manager. But if you look at the companies that we talked about today, the ones that are really implementing change and focusing on the future and the transition and really reducing that carbon footprint, that's a different portfolio. So just because some portfolio has a title that says ESG, it doesn't mean that it really is. So like anything else, sometimes you got to look underneath the hood and see what's in there. Is there anything you want to add to that, David, about the names that we have in there specifically?
Yeah, I would come back to the first page I went through, really focusing on the integration aspect versus the thematic. And when I look at thematic, I always think of the solutions providers. So think about companies that are providing products and services. And then if I look at integration, I'm looking for the companies that are making a transition. I wouldn't buy a company that just has attractive ESG metrics. I'm looking for a company that I can marry the fundamentals with and see market share growth, lower costs, better identification of risk. I mentioned data centers, for instance, during the conversation. There's a company called Switch that's very interesting. All of their electricity comes from renewable energy. And as a result, they've driven higher margins than most of their industry peers, and they've won over a larger client base, customers who want to be known for supporting renewable energy and the shift towards cleaner energy. So, I actually do think that there is a component to be had here, as far as, fighting climate change. And we've seen this transition away from coal over time. And I do think that economics are really what make the decision here. When I talk to these larger utilities like NextEra, Florida Power and Light, these are some of the smartest utilities that I've come across as far as understanding the numbers go. And when I first spoke to them in 2007, they said this stuff is on their radar, but we're really focused only on wind. And today, they've combined that portfolio to be wind and solar. But, when you look at the cost of creating electricity from some of these other technologies, this is really what it comes down to. It comes down to, having a more economically viable solution. And these are companies that they're not selling coal. What they're selling is electrons at the end of the day. So the question is how much does it cost them to create those electrons that they're selling to you? So, when I look at coal, we're looking at coal today, roughly $81 to $164 a megawatt hour to generate electricity. When I look at utility scale solar, it's $29 to $38. So it's a fraction of the cost. And as far as this is green has to be green. This is certainly, there's definitely a values component. There's definitely a do-good mission involved here. But as I said, ESG really focuses not only on the value side, but also the potential returns that we could see.
All right. We have a question about which subsector do you find most attractive from an ESG investment perspective?
For me, right now, one area that I think, as I emphasized during the call quite a bit, is advanced mobility. And this ties in areas such as telematics. It ties in vehicle electrification, vehicle autonomy. It's interesting to see the evolution of cars. I have 3 kids, and I had a 2010 version of an SUV that I then upgraded to the 2014 and recently upgraded to the 2020 version. It's amazing the level of technology in terms of safety, things like lane departure systems, or a focus on really, what I would call level 1, level 2 autonomy. And the key here is really building safety features in to the vehicle through what I would call autonomy. And so there's many more companies today that are starting to look at this. You've seen the IPOs of companies around LiDAR, for instance, which is really like a light emitting radar type system for cars. We've heard a lot more about sensors. We've heard a lot more about controls in cars. We've also heard about mainframes. You plug in your phone now into a car and it says, "Do you trust this computer?" And I think that there's a huge opportunity that's starting to evolve. Remember, they're selling the light vehicle industry globally is about 95 million cars a year. So we're just at the tip of this iceberg in terms of vehicle autonomy. When we think of electrification, it's only about 2% of total global car sales today. And the cost of driving an electric car, again, coming back to green has to be green, it's about $10, give or take, to fill a 100 kilowatt hour battery, depending on where you live in the United States. If I go the similar size, vehicle on the gasoline side, it could cost me $75 to $100 to fill that up. So it's 1/10 of the cost. And again, coming back to the economics, that's not hard to convince a consumer that I pay 1/10 of the gasoline price. And this is evolving technology. So there's batteries that are, they're talking about solid state batteries. They're talking about different composition batteries. You've probably heard about this from Tesla. But the thing is that we're still seeing an evolution. And, if I look back to my history of looking at renewables, I've seen solar for 25 years roughly, and where it was then versus where it is today, I can easily look at automotive and say, this is a massive market opportunity that several companies, be it batteries, be it automation, be it electrification, areas like telematics and efficiency, this is what companies are buying because these are solvable problems. They're better ways of doing things. So I actually do think that this is a good area to concentrate investment in, because I think it's going to happen. And I think that, things like GM coming out with a $120,000 Hummer electric truck 2 days ago and selling out overnight shows you that they are going to be a participant. They are going to be someone who's in the game, and that they recognize that it's happening. So I think this is still very, very early days around areas such as advanced mobility.
All right. Okay, I see a question on one of the myths that investors can either invest in sustainability or seek competitive returns, but not both. What are your thoughts on that? Let me take the first stab at this. It's true some people are willing to pay more to ensure that their investments have a positive impact on society and the environment. But the reality is today, you don't need to choose. Actively managed ESG funds can produce higher risk-adjusted returns relative to traditional or to non-ESG strategies, net of fees. Research has shown that a positive relationship between ESG factors and investment returns. However, research also shows that the benefits of sustainable investing can only be fully realized through active management. So if you're investing in an ETF, maybe it's not going to be exactly the same. Now, in other words, passive strategies using third-party ESG research to simply filter out or exclude certain investments it's not really particularly effective, regardless of the cost. So by contrast, strategies that actively incorporate ESG factors into security selection, they can enhance risk mitigation and improve portfolio returns. And this is what can result in higher risk-adjusted returns net of fees. Once again, it's important, though, that it is actively managed. Anything you want to add to that, David?
Yeah, I'd echo a similar sentiment. Like I said, I've been looking at this. I've been managing portfolios for more than 8 years, and I think the important thing to get across here is, it depends what you're going to benchmark it against. If I benchmark it to the S&P 500, for instance, there's a high tracking error. There's no question. And typically, I think if you're great at something, that's what you should do. That's where you should drive your returns. So I think that really, as an investment manager, you want to be concentrated, and that for me has meant owning 20 to 40 names in a portfolio and really doing the work and knowing the companies, knowing the management teams, being on top of it, knowing the technologies, knowing where the shifts are happening and being there early. But, I think that you can easily, and I think my performance shows that as a portfolio manager, you can easily outperform the various benchmarks. But, one of the things I can point you to is the S&P Dow Jones indexes. But if you look at the S&P 500 tear sheet for the S&P 500 environmentally and socially responsible index, if I look at the 1-year return, for that index versus the S&P 500, it's 27% versus 22% on the S&P 500. On a 1-year annualized return basis. On a 5-year, it's 15.6 versus 14.5. I'm a firm believer that this is easily the returns can outperform here, and I think that that's been shown in not only the indexes but also as a result of active management, as Joe said.
All right, thank you. Let me see. Okay, experience with ESG is important, and you guys have it, but what differentiates your approach to other ESG investors? David?
Well, I think that this, coming back to some of the value chain slides, I think that, it's important to really understand who the enablers are here. A lot of the funds that are out there, I've found, if they're larger funds, say a T. Rowe or BlackRock or something like that, there's not a dedicated manager to these, or dedicated research, dedicated manager, et cetera, in a lot of cases to these funds, as well as the track record, like I said, about 8 years of looking at this. But I think that, when you look at those other firms, they tend to not be as focused on the technologies. They tend to be wider spread. They tend to do a less concentrated strategy. And coming back to the approach that we take, looking at the value chain, and really understanding the top-down piece and then the bottom-up piece. So I think that if we look at that value chain and find a company, for instance, that does, infotainment and safety systems and really the brain of a computer of a car, who are the companies that can offer that? It might be a company like an Aptiv, for instance, or a Visteon. If I look at drivetrains, for instance, for electric vehicles, it might be a company like a Borg Warner or a Delphi or a Continental. Really those companies that are the enablers along that value chain. Because, having looked at the auto industry really since 2002, 2003, you realize that, these guys don't make their own components. They outsource to tier 1, tier 2, tier 3 suppliers. And, who can I find in the value chain who might be growing 20, 30, 40% year over year as a result of being a premier supplier on electric drivetrains or sensors? And finding those companies early is very important, and knowing those companies as well is equally important. Knowing the management team and getting access, I think that that's a real big differentiating factor. And as far as the strategy goes, I think that that's shown through in the results in being able to have a concentrated approach and knowing the companies that are there early and being able to drive active returns from those relationships.
All right. See, another question says, yes, we're seeing increasing demand for ESG, but what makes you think this will last and it's not just a passing fad? And I'll take the first stab at this. I talked before about what California is doing, how it's converting, And Gavin Newsom is actually forcing the pension funds to invest in strategies and companies that reduce the carbon footprint. This is a long-term plan. This is not a passing trend. We see the inflows coming into this. I mean, they cannot be disputed. Funds with these become almost every major company at this point is coming out with an ESG fund. So obviously the demand is there. Amazon even has commercials on TV saying that they are reducing their carbon footprint, which I find fascinating. So I think this is clearly the trend of the future, because it's not what's important here is that in the old days we had green funds, and that was more about companies that were only in the environmental industry, and a lot of them weren't particularly profitable, and people invested them just because they wanted to make a difference. But when you're adding the S and the G component, now we are talking about companies that are well run, companies that have potential for explosive growth, companies that can be disruptors. So no, I don't think in any way, shape, or form this is a passing trend. In fact, I believe by 2030, there's going to be more money invested in ESG funds than the entire stock market today. So this is clearly the next mega trend. And, you know, once again, most of the world gets it. The U.S. is kind of behind in this, but we're starting to catch up. So now's kind of a great time to jump in.
Yeah, I would just say when Morgan Stanley did a study recently that said that 94% of millennials believe it's important to have say with your investments. And they found similarly 75% of women investors believe that as well. You know, but I also say that the trends that we're seeing, you know, Joe said Amazon, for instance, they have a major investment in an electric vehicle company called Rivian. They just came out the other day with their electric delivery vehicle, and they've placed an order with Rivian for 10,000 of these. They're using more renewable energy. Companies are talking about in their annual reports the use of renewable energy, and energy is obviously a massive input for any company. But what I would liken this to is really, you know, and it might sound a bit commercial, but it's really not when you look at the numbers. But if I look at the late 90s into 2000s, what we saw was a tech shift, and we saw a lot of companies coming about on the technology side. Now, granted, technology back then was much more volatile. It was considered a higher volatility area with less certainty in their quarterly results. If I look at today, the stable companies that are out there are seen as the Apples, the Googles, the Amazons, you know, and then there's value, which people, you know, have been less attuned to. But, you know, I would say value with a catalyst is very important, as I said. But if I kind of shift forward to today, I see this, given the pronounced spending focus, you know, around areas like the Paris Climate Accord, the California prognostications, you know, what companies are doing. The spending component is what's going to drive growth for these companies, and that's why you want to be in it today. So similar to the tech boom that we saw in the early 2000s, I think we're poised for this, at least in the next decade, if not the next 2 decades, that's going to be driven around ESG companies with products and services, and companies that have great opportunities for disruption. Disruption is something, you know, at the end of the day, we've said this a lot, but really it's a better way of doing things. And if it makes sense economically, these are the companies to own. And cost reductions happen over time, right? Look at batteries. Batteries used to be $1,000 a kilowatt hour for cars, and now they're down to 100, and the target is now getting them down to 50. And these companies that make electric cars, like Tesla, are actually reducing the price of the cars. And when you get to the point where that first cost of a vehicle ends up being less than their gasoline incumbent, what I think that's going to be the tipping point, because range anxiety is no longer the concern. So, you know, you really do have a massive opportunity for growth here. And I think that certain areas, it's clear that growth is going to happen.
All right.
Well, wow. With that, I want to thank, before we do, first of all, before we do exit today's session, I want to thank Dave and Joe for a terrific presentation. But I also do want to take over the controls for just a moment here and show everyone where, through Interactive Brokers, where you'll be able to access those ESG scores using the Trader Workstation. Now, I've brought up the Trader Workstation here, and I did want to point out, notice that within the Mosaic interface, you'll find these arrowheads are included, as well as over in our advanced quote details. Now, you can expand this on an individual ticker symbol, and you'll find ESG scores are listed here. So notice that there are those scores that you can drill down deeper into any of these categories here. You'll also find some additional information on those scores as well. Now, that's just in our expanded quote details, but I also do want to point out underneath the New Window button, notice there is a Features Explorer that you can access, and you'll find expanded information in this section here. I'm going to simply scroll down a little bit further and notice that we do have, and oh, I scrolled a little bit too far there, we do have that ESG principles section where you can drill down to identify companies that may align with your values or not. So you can use this Fundamentals Explorer and the ESG tab here to drill down into any of the specific ratings that are available. By the way, I also want you to know that the data points from your ESG scores are also accessible and can be added. I'll simply close out of this window, can be added to any of your portfolio monitors or your watch list. They're even available if you do want to create, notice here, going into the Mosaic market scanners. Now, I'm simply going to bring up we'll set up or pull up a sample, but notice here, when I do go into the customize, that you have the ability to add those ESG ratings even into any of our market scanners. I'm sorry, not export the results, it's by adding a field. Notice here, as you scroll down, you'll be able to see those ESG different categories, combined scores, category scores, and even pillar scores. Simply expanding this section here, notice each of the different data points that can be added into any of your scanners or any of your quote lists. By the way, I also do want to point out recent enhancements with our client portal and the portfolio section will give you the ability to evaluate your portfolio's ESG scores. So do check that out. Well, with that, I'm going to bring us back over into our session here today, and also do want to point out that you'll find on the control panel on the right-hand side, in the handout pane, if you do want a copy of today's slides, notice that you can download them directly before you do exit today's presentation. By the way, a quick reminder, we have been recording today's event, and each of you will get a direct link to today's recorded playback soon after this session ends. So if you do want to come back and review the concepts and access the same webinar notes that we've been discussing today, simply watch your inbox later on this afternoon for those direct links. Well, with that, I want to thank both Joe Pastore and David Smith from Platinum Eco Capital for today's presentation. I did see many questions there. If you do want to contact Joe, he's been gracious enough to leave his contact information there. So with that, we are going to conclude our event today. Thank you all for your participation with us here today, and a great deal of thanks to Platinum Eco Capital for an excellent presentation. Thanks, everyone. You can all exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, all. Thanks so much.